this section, we're going to talk about the Federal Reserve Bank. Now, it's important to note that the Federal Reserve is not officially part of the United States government. It was chartered by Congress, but it is a private corporation. It's a not-for-profit corporation, and that makes a lot of people feel uncomfortable. There's all kinds of conspiracy theories about the Federal Reserve. However, the Federal Reserve publishes its balance sheets and income statements, and any excess cash or profits goes directly into the U.S. Treasury. So how does the Federal Reserve operate, and what is it for? Well, the Federal Reserve, it was created for one primary purpose, and that was to deal with runs on the bank. In the late 1800s, we started to have enormous numbers of banks that were failing because there would be some kind of news item that they weren't doing well or something. They would have a run on their bank. And they didn't have the money to be able to pay people because they'd loaned the money out for mortgages and car payments and so forth. So the government created the Federal Reserve to try to do this, and they considered it the lender of last resort. In other words, the banks could have the Federal Reserve that they could go to. So when they had a run on their bank, they had no place to go to get currency because they'd loaned it out. And so the Federal Reserve banks were set up around the country in places where they could get quickly to the bank overnight and deliver currency so that the banks would have a bank, what they call a bank holiday, close the doors, open up the next day, and they'd have all the currency to give it out to people. Once they started doing this, once people started realizing that this was the case, we stopped having the major runs on banks. Now, we still had some, and there's a very important story about that, which I'm going to tell you about later. But let's talk about how the Federal Reserve is organized. First, the Federal Reserve has a chairperson. Currently, that would be Jerome Powell. The chairperson serves a 4-year term and serves in a 4-year term that's offset from the President of the United States. So the President of the United States, after 2 years, is going to be able to put in his own person in there. But he receives the President of the Federal Reserve, the chairperson of the Federal Reserve, from the prior presidency and inherits it for 2 years. So that way, we try to minimize the effect of politics on the Federal. The Federal Reserve President or chairperson, the Federal Reserve chairperson, is appointed by the President of the United States and confirmed by the Senate. The Fed also has a board of directors. The board of directors consists of the chairperson and 12 board members. Those 12 board members come in 2 groups. First, there are 7 that are appointed and confirmed by the President and the Senate. Those serve for 14-year terms, and one of them is replaced every 2 years. However, there are also 5 additional board members, and these are elected by the presidents of the 12 Federal Reserve banks. And so it's very difficult for politics to enter into controlling the Federal Reserve. The central bank is in Washington, D.C., and the other banks are situated around the country in important cities. Now, the main function of the Federal Reserve, as I said earlier, originally was the lender of last resort. And that means that if a bank gets into trouble, that they could contact the Federal Reserve closest to them, and they would rush out with some cash and help deal with that. This kind of a problem is what we call a liquidity problem. And many of the banks used to have this problem of liquidity, but the Federal Reserve was established to solve it. So let me tell you the story about the Bank of the United States. But there was one particular private bank in New York City, and that bank was situated in the Diamond and Clothing District of New York, which is primarily people of Jewish descent. This bank happened to be the largest private bank in the United States, very prosperous. And they were very lucky because they were able to get the name, the Bank of the United States. Now, one day, they had a run on that bank, and the president of the Bank of the United States picked up the phone, and he called the Federal Reserve Bank in New York City. The Federal Reserve Bank president in New York City was anti-Semitic. And he saw this as an opportunity to punish the Jewish people. And so he told them, good luck, and hung up the phone. Well, the next day, the headlines of the New York Times, which is read all over the world, great big headlines said, Bank of the United States fails. Now, even though it was one bank, just a little branch of a single bank, you can imagine that people throughout the world saw this as the Bank of the United States of America, the bank for the whole country failed. And this caused a run on many of the other banks as well. It was one of the reasons we went into the Great Depression. Now, the Fed originally just had this one function, but of course, it found other purposes. And one of the early purposes that it found was it was used to audit the banks for stability. Now, a bank can fail for two reasons. One would be liquidity, where it's unable to get the cash it needs to give out to its customers. Other functions that the Federal Reserve took on was the need to check on the solvency of the banks. And so it would audit the banks for solvency to make sure that they had equity. And if they didn't, then those banks would be forced to shut down and their assets would be moved over to another bank. Now, they were also asked to manage the money supply. That meant that in different situations, they would have to increase the money supply or decrease the money supply. And they created a committee, the Federal Open Market Committee, FOMC, whose purpose was to meet every 6 weeks. It was part of the board, and their job was to determine how much to increase or decrease the money supply. Now, how do they do that? How do you increase the money supply or decrease the money supply? It's not enough just to print the money and store it in a warehouse. Somehow, the money has to get out into people's hands. And so they came up with the idea of open market operations. Open market operations are very simple. Buying and selling U.S. Treasuries on the open market. So if you want to increase the money supply, you're going to print money, and buy treasuries. You buy the treasuries and you put money into the economy. If you want to decrease the money supply, you sell those treasuries. People give you money, you give them the treasuries, now you can destroy that money and the money supply gets smaller. So open market operations was a very simple way to increase and decrease the money supply. This is called monetary policy. So when the Federal Reserve is trying to address issues in the economy and it prints money and puts it in or takes money out of the economy, we say they're exercising monetary policy. Now, in contrast, when the U.S. government is trying to address issues in the economy, we call that fiscal policy. So they're two different things. Now, there are some other tools that the Fed has that it can use to try to deal with some of these issues. One of them is the discount rate. The discount rate is the rate that the Federal Reserve charges banks to borrow money. So if the banks want to borrow money, they can borrow it from the Fed, and they charge it the discount rate. Now, this is going to be very confusing. So pay attention because this is a difficult problem. The money coming from the Fed is the discount rate. But if the banks want to borrow money from each other, we call it the federal funds rate. I know it should be the other way around, but it isn't. So the federal funds rate is the rate that's charged between the banks, and the discount rate is the rate from the Fed to the banks. Now, in addition to that, recently, the Federal Reserve came up with the idea of paying interest on reserves. So now if the banks keep money with the Fed, they earn interest on that money. And so this has been one way of decreasing the money supply, even though we actually printed a whole bunch of money. Now, traditionally, they also had this tool called reserve requirements. But reserve requirements are such a big weapon, a big tool, that it causes huge changes in the money supply. It's not a very fine tool that can be used to incrementally make changes. And so it hasn't been used for years. The reserve requirements are fixed. And finally, they have something called term auction facilities. And these are basically an auction held periodically to put money into the economy or take money